Everyone thinks they know Caterpillar. You see a yellow bulldozer on the side of the highway, and you think cyclical. You think old economy. You think when interest rates go up, this stock goes down. If that is your thesis, you are looking at the wrong company. You are looking at the Caterpillar of 1990, not the Caterpillar of 2025. Today, we are tearing apart the financial statements of the world's largest industrial manufacturer. We have analyzed the boom of 2021 to 2023, the feared bust of 2024, and the shocking reality revealed in the Q1, Q2, and Q3 slides of 2025. What we found is a company that has effectively decoupled its profit from its sales volume. A company that is generating software-like margins on heavy iron. This is the story of how Caterpillar engineered the ultimate cash flow machine. Let's start with the bear case that turned out to be wrong. Going into 2024 and 2025, Wall Street was terrified. Interest rates were at multi-decade highs. Residential construction was slowing down. Dealers were destocking, meaning they stopped ordering new machines to clear out their lots. In the old days, this combination would have destroyed Caterpillar's earnings. Revenue would drop, fixed costs would eat the margins, and the stock would crash. But look at the data from the third quarter of 2025. Yes, the top-line revenue faced headwinds due to lower sales volumes. But look at the adjusted operating profit margin. It didn't crash. It expanded. In Q3 2025, despite lower machine volume, Caterpillar delivered an adjusted profit of over $3.1 billion. How is this mathematically possible? How do you make more money by selling fewer machines? The answer lies in the services revolution. According to the 2024 annual report, services revenue hit $24 billion. Let me put that into perspective. Caterpillar's service business alone is bigger than many companies in the S&P 500. This revenue comes from aftermarket parts, maintenance contracts, and digital subscriptions. It is recurring. It is high margin. And crucially, it is recession-proof. When the economy slows down, construction companies don't buy new bulldozers, they fix the old ones. That means they buy parts from Caterpillar. This creates a profit floor that never existed before. Now, let's pivot to the hidden tech story found in the Investor Day 2025 files. The narrative here isn't just about moving dirt. It's about the mini supercycle. The world is undergoing an energy transition. We need copper for EVs. We need lithium for batteries. We need nickel. But here's the problem. Ore grade decline. The easy-to-find minerals are gone. To get the same amount of copper today, miners have to dig up significantly more rock than they did 10 years ago. This is a gold mine for Caterpillar. Miners need massive, autonomous trucks that can run 24/7 without a driver. Caterpillar is the leader in autonomous haulage. These aren't just trucks, they're robots. In the 2025 slides, the resource industry segment shows incredible resilience because miners are prioritizing tech updates over fleet expansion. They are buying Caterpillar's autonomy software to squeeze efficiency out of their mines. Let's talk about pricing power. Throughout the inflationary period of 2022 and 2023, Caterpillar raised prices aggressively. Critics said they will lose market share. They didn't. The Q1 and Q2 2025 data shows that price realization continues to be a tailwind. Customers are sticky. If you have a fleet of Cat machines, you can't just switch to Komatsu or Seini overnight. The switching costs are too high. This gives Caterpillar an inflation hedge that most tech companies would kill for. However, we must look at the risks with a critical eye. The primary risk we see in the 2025 filings is dealer inventory management. For the past few quarters, dealers have been reducing their inventory. This acts as a drag on Caterpillar's sales. If this destocking phase lasts longer than expected, or if end-user demand falls off a cliff due to a recession, the stock could re-rate lower. Also watch China. The construction market in China has been weak for years. While Caterpillar has reduced its exposure there, a complete collapse in the Chinese property sector still sends ripples through the global commodity markets. So, what is the verdict? Caterpillar has graduated. It is no longer a simple cyclical trade. It has evolved into a structural compounder, with a balance sheet rated A by credit agencies and a dividend streak of over 30 years. It offers safety. But with the mining supercycle and the services transformation, it offers growth. The next 100 years strategy unveiled in 2025 is not a roadmap for selling more diesel engines. It is a declaration of war on inefficiency. Caterpillar is pivoting from being a hardware manufacturer to becoming the operating system of the industrial world. They are selling the autonomous software that runs the mines. They are selling the hydrogen generators that power the grid. They are selling the battery electric fleets that build the future. This brings us to the most critical point for investors. The bust you are waiting for may never come. Historically, CAT stock would crash 40 or 50% when the economy slowed. But that was when they only sold iron. Today, with a $24 billion services fortress and a backlog driven by the secular energy transition, the floor of this stock has structurally moved higher. We are witnessing a valuation re-rating. The market is starting to realize that Caterpillar is no longer just a proxy for construction. It is a critical technology play on the scarcity of resources. Caterpillar doesn't just build the world anymore. By guaranteeing uptime and efficiency, they are the ones keeping the world running. And that is a business model that deserves a premium.